Hey everybody, this is Tim. I just wanted to put this short video together to go over what happened at the Fed meeting today. Obviously, they've had the Fed meeting the last couple of days, and then they've been having the press conference. It's still ongoing right now as I'm making this video. The press conference is still ongoing, but for the most part, the main comments have come out of the Fed meeting, and then Powell speaking afterwards. We've gotten an idea of kind of what they're looking at there and how the comments are going to impact the markets, things like that. Over the past couple of meetings, his comments have been incredibly negative after the meeting, even though they did a rate cut. He would still have very negative comments, making it seem like that they wouldn't do rate cuts again in the future or whatever. And whenever that happened, it really hurt the market. Today, his comments were not as negative. There were some things you could probably take from it that you could consider to be a little bit negative, but not like we have seen in the past. And as a result, the market responded more favorably today so far compared to what we have been seeing from him in the past. So it may be that he became a little bit self-aware of how his comments have impacted the markets and tried to make sure he didn't do that today quite as badly. So if we're looking at the current market, earlier today, prior to his comments, I think we were like around 5 or 6 basis points up on the 30-year bond, which helps rates. But that has moved to about 16 basis points now because his comments were not as negative as some people were expecting. They did say during the meeting that they're expecting. I think they said that they're expecting like one rate cut next year, which I thought that might be perceived negatively, but I also think that's inaccurate. I think that they will do at least 3 or 4 rate cuts next year. They also said they expect the job market to be better next year and lower unemployment next year compared to what we've been seeing recently, and I think they're way off on that. I think that those things are going to continue to get worse. I don't think that they are considering the entire impact of AI and what that's going to do to the job market moving forward. We've already been seeing a lot of these technology companies and stuff laying people off like crazy, and that's because they're utilizing AI and they don't need as many people. And you will see some of those people move into other things, and you will see AI create a few jobs as well. But I think that the overall impact is certainly going to be negative on the job market, and we're going to see a lot of job losses, I think, due to AI next year. And I think the unemployment rate is going to rise, and as a result, they'll need to make more cuts next year. Now, Powell's term doesn't end. I was thinking it ended in March, but it actually doesn't end until May. And so, as a result of that, the next person is going to be much more favorable toward additional rate cuts. They're going to be somebody who wants more rate cuts, and I think that's going to help move the market to more rate cuts in the latter part of next year. Might only see 1 rate cut prior to May of next year, but then I think after May you're going to see at least 2 or 3 rate cuts, and that's because of the new Fed chair wanting lower rates. And part of this will also depend upon what happens in the job market and the unemployment rate and things like that. If it's as negative as I think, you might see the current Fed before Powell's term end make more than the 1 rate cut. So we'll just have to kind of see how that goes. But no, I think that for those people who have purchased this year, I think we're going to see interest rates be at least 1% lower by the end of next year. And so if you're currently at, like, let's say you're at 6 or 6.5, then by the end of next year, rates are going to be 5 to 5.5. And if we're down at 5 or possibly even a little bit lower than 5 by the end of next year, there's going to be a huge opportunity for a lot of refinances to take place during the latter part of next year. So anyway, that's some of what I wanted to cover here. As you can see, this is what the market looks like right now. There are a couple levels of ceilings here that we have to break through before we can get back to where we were like last week after the negatives. But we're at least on the right track, and if you look at the 10-year, it moves the same direction as rates. Rates had gone up some right here, and now they've dropped back down some, but we've got 1, 2, 3 levels of support to keep us from getting too low, and we're going to have to break through those before we really get to see it be back to where it was. Now, the funny thing is, when we were here, interest rates were actually lower than they were back here, which you wouldn't think that by looking at this, but that's because of the 30-year. When you look at where the 30-year was, we were up here on the 30-year, and the 30-year is really what rates are based on. The higher the 30-year, the lower the rates, and so we're not that far off from that. If we get, I think when you're looking at it, we're like maybe 50 basis points or so away from being pretty close to where we were, back here, which was, what was the date there? That was like, October, November, something like that. So it wasn't very long ago that we were there. But anyway, that's what we're looking at right now. I think that they probably won't do a rate cut in January, but I think, February, March, April, somewhere in there, we'll probably see a 25 basis point rate cut, and it will depend upon the market and what happens with employment and job creations. We've been seeing actual negative jobs here over the last few weeks, and that's a big problem. So that's what I wanted to cover. If you have any questions or anything, let me know. I'm always here to help. Thanks.